Welcome to the Ellsworth Advisors monthly update. I'm Kelly Keenan, Cameron Mealy. Today we will review how the markets did through the month and year to date. Also talk about our portfolios, what's working, what didn't work, and really get a good economic review as to what's been happening and kind of what we think is going to happen in the next couple of months. Cameron, why don't you kick us off with some economic numbers?
Thank you, Kelly. Good afternoon, everybody. A couple of big news items that we've seen over the last week. Not really market moving, but still points to talk about. Number one, the bankruptcy filing of Yellow Freight. So many of you probably saw the news. Yellow Freight, 99-year-old company, ceased operations this week. They've laid off 30,000 employees. And really the Yellow story is kind of a story of aggressive acquisitions, using a lot of debt, not being able to make concessions with the Teamsters union. And ultimately, they were in a tough financial position. Large customers like Walmart started pulling back their shipments. Shipment volume was down significantly. Ultimately, Yellow Freight was not able to achieve $1.3 billion of new debt financing and filed for bankruptcy, terminated their employees, ceased operations. So disappointing. See 30,000 American workers out of work, but really for them, that's a story of debt. That's a story of higher interest rates. Bad situation there. Other piece of interesting news, and can't say this was a surprise. It was a little bit of a shock, but not a surprise that it was coming. August 2nd, Fitch Ratings out of London downgraded the U.S. from AAA to AA+. This follows on suit with what S&P has already done. But really, if you look at downgrade, this...
Well, S&P did it back in 2011.
Yes.
So it does... It kind of means something, but it doesn't mean a lot.
Well, it's not going to affect the U.S.'s ability to issue debt.
Correct.
It's not going to affect, the U.S. still being the safe haven of the world economy. But what is interesting is, this is a quote from Fitch, "The rating downgrade of the United States reflects the expected fiscal deterioration over the next 3 years, a high and growing general government debt burden, and the erosion of governments relative to AA and AAA rated peers over the last 2 decades that is manifested in repeat debt limit standoffs and last-minute resolutions." Basically, in my opinion, this is Fitch telling the U.S. government that they have to get their house in order. Right. Whether it's Democrat, whether it's Republican, both parties are addicted to spending. They've realized that the way they stay in power is through handouts to the consumers and businesses. We are now, year after year, running multi-trillion-dollar deficits. And as we all know, individuals, businesses, you can't operate like that.
Yeah, the reality is, I just heard these numbers this morning, the government spending is 25% of GDP, revenues are 19% of GDP. A couple of years ago, spending was 21% of GDP, revenue was 17% of GDP. That difference between revenues and spending, obviously that's created these deficits, and this may change the focus of the elections and what's talked about in Washington. Theoretically, it should. It never really does. Yep. It's kind of the way it is.
And both parties, as I said, are guilty of it.
And the other side of it is, okay, yeah, we're downgraded, but how do we, really it's more relative to the rest of the world, other countries. As Cameron said, we're still the reserve currency, and we're as strong, if not stronger, than any other country from a banking monetary standpoint.
Yep.
So a lot really doesn't change. Warren Buffett was talking this morning. He has $10 billion that, is in short-term treasuries right now, and when they come due, he'll be $10 billion in short-term treasuries again. Yeah. So he's not changing anything.
That's the practical way. Where are you going to put your money?
It's a little bit of a warning shot, and I think it may change some of the discussions for the election, which could be a good thing. Mm-hmm. We're, away from the mudslinging that goes on right now. We'll see. Not keeping my hopes up.
No.
But it doesn't change anything we do. What it is going to do, I think, is, we're seeing it yesterday and today. It's going to cause some market volatility, that's for sure.
Yep. So on top of that news, if we just look at general economic news, we got the advanced estimate from the Bureau of Economic Analysis on July 27th. That shows GDP grew at an annualized rate of 2.4% in the second quarter. A strong number above the target of 2%, above 2% that we realized in the first quarter. We also had some inflation data So personal consumption expenditure index, again, this is also the Bureau of Economic Analysis. July 28th, they published this, and it is showing that inflation continues to come down. So the June month-over-month increase was 0.2%. The June year-over-year increase in inflation was 3%. This is the smallest year-over-year increase since 2021. So good sign that we continue to see inflation coming down. It's still not where the Fed wants it to be, that 2% range, but it has trended down significantly from, it was almost 9%, not only, 12, 18 months ago.
And one comment on that, I think we talked about a little bit last month, the way the data stacks up from last year, the base data, which inflation's measured compared to last year. So what was the number? Up 3%. 3% from last year. And because of the base data, I think we're probably gonna have another month where it's gonna, look fairly benign, where, hey, in that 2 to 3 range. But the reality is as we get into the fall, we're gonna see that spread start to increase again. And, he mentioned the monthly increase is 0.2%. And if there's 0% increases on a monthly basis, because the way the data stacks up, we'd still be at around 2.8% for annual inflation rate come December, January. Realistically, we're probably
still rolling off bad numbers.
Yeah, we're still going to be in probably the high threes based on the pace we're on right now. So inflation still, there's a ways to go there.
And speaking of inflation and the Fed's response, obviously everybody saw on July 26th, the Fed announced a widely anticipated 25 basis point increase in the federal funds target rate. That takes the target from 5% to 5.25%. This is now the 11th increase in 12 Fed meetings. The Fed has 3 meetings left this year. Pundits widely speculate that we'll have another 25 basis point increase before the end of the year.
Yeah, the talk is September. They'll probably bump again then. How does the Fitch thing affect things? Maybe that changes. Who knows? Depends how much the market gets bounced around. 2011, we saw a short-term pullback with the downgrade by S&P back at that time. The reality is the economy has been more resilient than expected. A year ago or 8 months ago, 6 months ago, I would have said, hey, we're probably going to be in recession at this point in time by second quarter, third quarter. It hasn't happened. It's more of I'd say, or it's been described as a rolling recession where certain industries are going through it, other sectors, industries are not. And we're just kind of, wallowing around here is really what's going on.
But this is going to create some challenges for the Fed
absolutely.
Because we look at 2.4% GDP increase. We also have a very strong jobs market, historically low unemployment rate of 3.6%. The June JOLTS report, which is the unfilled jobs, came in at 9.6 million. So that's 9.6 million unfilled jobs, but that's down from 12 million in May of 2022. So the economy still looks strong.
Right.
Interest rates are increasing. And on top of that, I think one of the most fascinating pieces of information that's come out is August 1st, the Atlanta Fed's GDP Now model. They are now projecting a 3.9% annualized increase in the third quarter. So low unemployment could be a blowout GDP.
Right.
Interest rates creep. It's the Fed is in this tough point where they need to push, but if they push too hard, they will push the economy into recession. Jerome Powell and the team there, they're walking a very fine line right now.
That's exactly right. And the big thing is they really need to kill off inflation because that does the most damage in the economy. That hits, people across the board. And, it's kind of been the common theme here is, what to expect is a little bit kind of more of the same. We've had a nice little run up in the market, but we're seeing a little bit of weakness in the last couple of days. Definitely, getting late in the summer, we're getting into that season where you see some volatility, and I think we might be seeing the start of it. But then again, things can start marching back up after a couple of days of downside. It's just we need to remain prudent and know that at any given point in time, valuations could begin to matter. The yellow freight thing that really highlights coming issues that we're going to see. Yellow freight's not going to be the last company that goes under. Well-established companies, those companies that have gotten way extended from a debt standpoint, as they have to start refinancing, that's when the rubber's going to start hitting the road. So I think we're going to see more of that to come. And, selectivity with our investments is going to be key, which kind of leads me right into what's been going on, from a market standpoint. So year to date, the Dow Jones up 7.23%. For the month, Dow Jones up 7.23%. The S&P up 19.5%. The Nasdaq's up 37%. The Russell 2000, which is more small cap stocks, now up 13.7%. So we've seen small cap stocks definitely pick up. And even the Dow, has made up a lot of ground because that was lagging the S&P and the Nasdaq fairly substantially. Except for the last couple of months, we're seeing a bit of a catch-up. Internationally, the MSCI EAFE up 13%, emerging markets up 10.7%. So across the board, markets are up. For the month, the S&P 500, which definitely lagged in June and July, up 3.1%. The Dow outperformed 3.4%. Nasdaq up 4%. Russell 2000, like I said, they picked up 6% last month. Internationally, the EFA up 3%, and emerging markets kind of in line with the Nasdaq up, up with the Russell up 6%. So good performance out of the indexes. Our portfolios, our growth with income portfolio, once again, more of a balanced portfolio. July up 2.3%, year to date up 10%. So halfway through the year, a little more, up 10%. We're pretty happy with that. Big gainers, we're seeing some resurgence in energy. EOG Resources up 16.6% for the month. NVIDIA keeps on going, up 10.5%. CVS picked up 9%. Iron Mountain, which is the newer holding of ours, up 8%. Big laggards, Raytheon down 10.2%. Honeywell gave up 6.5%. Our real estate investment trust, our ETF, down 2.9%. Year to date, still the big gainers, NVIDIA up 220%, Apple up 52%. That's why the Nasdaq's up so much. Yep. Those are two big holdings in there. Lennar, the builders, 41.6%. I mean, that whole home building story just keeps chugging along. Nucor, seeing some resurgence in materials, up 31%. So some nice gainers there. Year to date, even though CVS was up 9% last month, down 18% for the year. Raytheon still down 11% for the year. Nike down 5%. Nike's kind of picking up some ground there. Our dividend yield portfolio, and here's kind of our most conservative stocks, our dividend yielding stocks. In July, 3.6%. They've been lagging. Year to date, they're only up 6%. So they made up a lot of ground recently, seeing kind of a rotation from, high growth tech stocks to more your multinational, boring, high dividend payers
with great balance sheets and strong cash flow.
So we're seeing a little shift there. Big gainers in there. U.S. Bank up 20%, and we bought them right around the time of the Silicon Valley thing. So they've made a nice rebound. Packaging Corp up 16%, Paychex up 12%, Blackstone up 16.6%. That's for the month. During the month, though, Merck gave back 7.8%. Verizon gave up 6.7%. Waste Management gave up 5.6%. Year to date, Blackstone is still a big gainer, up 45%. Eaton up 32%. LyondellBasell up 22%. Packaging Corp of America up 22%. Year to date, Pfizer still lagging, down 20.5%. Verizon down 9%. 3M down 4.4%. Price Potential, also another one of our widely held portfolios. July, kind of a lackluster month for Price Potential. Only up 2% for July. Year to date, we're up 11.7%. Definitely more growth oriented, but we have an eye to valuations, which kept us out of the high flying stocks. Big gainers in July. Union Pacific up 13.4%. Archer Daniels up 12.4%. Hub Group, not Grubhub, we wouldn't be in there. Up 12.3%, and Intuit up 11.9%. That's for the month. Laggers, Juniper Networks gave up 11.3%. Genpact down 4%. Corteva down 1.5%. Still in the portfolio, big year-to-date gainer. Visa's up 14%. We've sold off a lot of other year-to-date gainers, and then laggers year-to-date, Humana down 10%. Small cap stocks, I mentioned the index did very well. July, we were up 3.3% in our small mid-cap portfolio. Year-to-date, we're lagging in here. We're only up 4.4% for the year. Gainers last month, Covenant Logistics up 25%. We just added that at the beginning of the month. That was a nice bounce. Sylvamo up 22%, Nuvalent up 18, Assure Software up 12, Performed Line Products up 11.5. Actually, this morning, Powell Industries had about a 40% pop. We'll see how that holds out by next month. If it's still there, it's going to be great. Laggards, Consolidated Water down 19.3. RCI Hospitality down 8.2. LeMaitre Vascular down 6. Big gainers, Lantheus up 70. And we talk about that every month. And they even last year, they kept on rolling. CSW Industries up 56. Year-to-date, Consolidated Water, even though it gave up last month, still up 33%. Big laggard last month was RCI Hospitality down 25%. Long-term price growth, year-to-date up 2.3. I'm sorry, July up 2.3, year-to-date up 24. This is where we have some exposure in the high-flying stocks. July, Meta was up 11, FedEx up 9. Laggards, Merck still down 7.6 in there, Verizon down 6.7. Year-to-date big gainers, Meta 164%, FedEx up 57.6, which probably going to be helped by the yellow freight issue. Generac up 53. Laggards, all states lagged at down 15.6, Verizon down 9. So that's kind of where we're at. And, expectation-wise, like I said, we're going to stick with quality. On the bond side, we're still getting good rates. We're starting to see the longer-term bonds increase a little bit. 10-years back above 4%. Got above 4% maybe a month ago or so. Retreated. I think with the Fitch news and the reality that the economy is still strong, probably see the longer-term rates bump up a little bit. The 10-year kind of mortgage rates kind of follow the 10-year. So I think, 6s and 7s for, 6%, 7% for 30-year mortgages is becoming the new reality.
It's the new norm right now.
Or at least it's going to be that way for a while.
So thank you very much. If you have any questions, as always, please feel free to reach out to us. We appreciate your trust. Have a great month, and we'll speak to you again in September.
Thank you.